One of the things I love about helping people with mortgages is just how customizable mortgages really are. A lot of people think that all there really is are 30-year fixed mortgages, and it's just about going through a pre-approval process and then finding the right home and closing on that loan. Well, there's a whole lot more to mortgage financing than maybe there is at first glance. And one of the ways that we can customize loans is by manipulating interest rates and closing costs. And that's exactly what I'm going to be talking about today to show you how you can use an understanding of interest rates and closing costs to your benefit. My name is Scott Wynn, and I am a licensed mortgage advisor with the Wynn and Egan team at Citywide Home Loans. If you want to buy a home in the next 12 months, then click that subscribe button, and together we'll make it happen. Did you know that you can reduce the amount of closing costs that you pay on your mortgage? Maybe you've heard of no-cost refinances or premium pricing. Both of these things are what I'm referring to, and I'm going to get into the details so you understand what it is, how it works, and how to utilize it to your benefit. So let's talk about, first of all, interest rates. See, each interest rate has a price associated with that rate. What you'll generally see when you're getting rates online or talking with lenders about what the rate is, well, what they're quoting you is what's referred to as the par rate. The par rate is the rate that is closest to or right on target with a zero cost and a zero credit price. But here's what you can do. You can increase your interest rate, and by doing so, you get a negative price or a rebate that can be used to offset your closing costs. That rebate is in terms of a percentage of your loan amount that you're going to be financing. Now, the opposite is true as well. You can decrease your interest rate, but in doing so, there is a positive price or a cost associated with obtaining that interest rate. And that's what's called discount points. Here's a sample rate sheet. Now, this is just a snapshot. This is not to provide accurate, up-to-date information about interest rates in any way, shape, or form, but rather just to explain how rates work. So if we look at the sample rate sheet, what you can see here is that 2.875% is the closest rate to the par rate, that or 2.75%. So as you can see, a 2.75% would cost 0.238%, while 2.875% rate would provide a credit of 0.351% of the loan amount. Now today, I'm going to focus on premium pricing, the increase the interest rate to help offset closing costs. Many people utilize this idea to get what's called a no-cost refinance. There's really no such thing as a no-cost refinance, but that's what's been termed in a marketing world in order to lure people into utilizing premium pricing and looking at refinances and to make them appear better than maybe they actually are. A no-cost refinance is basically increasing the interest rate high enough in order to get a large enough rebate to help offset all the closing costs on a refinance transaction, therefore resulting in a no-cost refinance. But now you understand that really all that's happening is you're rolling those costs into the interest rate. Well, the same can be done on a purchase transaction. Let's just say that you are looking at purchasing a home, but you just don't have all the cash to pay for both down payment and closing costs. Well, in some cases, you can ask the seller to help pay for your closing costs. But in very competitive markets, not a lot of sellers are willing to do that. So your best alternative is to turn to your interest rate. If you increase your interest rate just a little bit, what you can do is you can get that rebate back to help cover your closing costs. Basically the same thing as the no-cost refinance, just in a purchase transaction instead. Would you like to know the best way to utilize premium pricing? It's by giving this video a thumbs up. By doing so, you'll get the lowest possible cost and interest rate for the highest possible rebate in closing costs. I'm kidding, of course, but giving a thumbs up on this video will help me reach more people like you interested in how to utilize the mortgage to their benefit. So please do that if you're enjoying this video. Now, how much you increase your interest rate and how much of a rebate you get back, there's no set criteria or amount that will impact you. In fact, the amount that you'll get in the rebate versus how much you're going to have to increase the rate to do it is going to depend on lots of factors. Your qualifications, things like how much of a down payment you're putting down, your credit score, maybe the type of property that you're buying will impact the interest rate and the rebate that you'll get. Other factors are going to be market conditions. Interest rates in the mortgage world move similar to how the stock market does. It's always up and down and all over the place. And so there's no set amount that you're going to get in return for the increase in interest rate. The best thing you can do is to talk with your mortgage lender to determine whether or not premium pricing makes sense for you and how much the cost is in interest rate to get you the reduced closing costs. But it's not just for people that don't have the cash for closing to pay for closing costs. Premium pricing can be a financial strategy to manipulate your mortgage loan in order to achieve what you're looking to do. Here's what I mean. There is a break-even point that will occur when looking at premium pricing on your loan. Let's just take a hypothetical, easy scenario that I can share with you how this would work. Let's just say that we need to offset our closing costs by $2,000. And in doing so, that's going to increase the interest rate that's going to therefore increase your payment by $50 a month. Well, to calculate the break-even point, we just simply take the $2,000 rebate that you're getting and you divide it by the $50 per month increase in price. You get a result of 40 months. That 40 months, that's your break-even point. That's the point in time where premium pricing is better before and worse after. What I mean is that you benefited in terms of $2,000 less at the time of closing. So for the first 40 months, you're benefiting because you've paid less in higher monthly payments in comparison to the benefit you got at closing. But after 40 months, that's the point in time where you're going to start paying more in terms of monthly payments versus the rebate that you got at closing. So if you look at this and you understand that maybe this is a starter home, you're only going to live there for a year and a half, 2 years, maybe 3 years, something like that, then premium pricing might make sense. But if you anticipate this being a longer term home, premium pricing will actually be a negative because you'll end up paying more in terms of higher monthly payments in comparison to the rebate that you got at the time of closing. So there you have it, premium pricing, how to manipulate the mortgage to benefit you, whether that's for reduced closing costs because you don't have the cash to pay for it at closing, or because you know you're only going to live in the house for a short period of time and you want to do what's financially best for you rather than the lender.